Hi, it's Lee and welcome to the Tech Economist. Tesla is very much a growth stock. Why? Because we aren't even at 1/10 the vehicle run rate we expect to see around the end of this decade. Producing 10 times more products is a lot of growth. And that's just vehicles. We also expect a lot of growth for energy, going from 6.5 gigawatt hours deployed last year to 1,000 gigawatt hours deployed by around 2030, around 150 times increase in energy. A lot of the vehicle growth will be from lower cost models, but over this period we also expect Tesla to get their costs down significantly, in the hope that they're still producing similar profits per vehicle sold, even when they're doing massive quantities of sales. Then there's the technology growth we also expect, namely FSD, and all the potential profit that brings the company too, along with potential robotaxis. These are the lottery tickets that make Tesla an exceptionally valuable company. On top of that, we also have new products like robots or HVAC systems and whatever else Tesla decide to bring out in the future. In other words, Tesla is still a young company and has a long way to go. Their engineers are working hard around the clock to achieve this as soon as they possibly can. And due to all this future growth, Tesla is valued as a growth stock with a high PE ratio. However, despite that, earlier this year, Tesla's PE ratio dropped to the low 30s, with a forward PE ratio of close to 20, implying if the stock price had held through the year and Tesla's earnings were around $15 billion for the year, then the PE ratio would be 20 at the end of the year. Now, a PE ratio of 20 is actually quite a good return. If, for example, they paid all the earnings into dividends, that would be a 5% return, which is comparable with some bonds. In fact, this is comparable with value stocks. Right now, the market is dropping. It had a great bull run in January due to additional liquidity added into the economy, and we saw another temporary bull run, although it may now appear to have been a bull trap. The market is concerned that rates may rise higher than expected, and is being extra cautious as a result. The market is trying to work out what the jobs numbers we just received mean in regards to inflation. Will we see more disinflation, or is it going to be sticky? So there's more fear in the market, hence we're seeing stocks drop. And also now fears of pressure on the banks, which is a concern as it may trigger an actual financial crisis, which is what we're trying to avoid with a soft landing. Although Tesla seemed to be one of the only stocks in the green today, although it did dip below 170 at one stage in today's trading, but the entire market is now at the mercy of the macros. If rates rise more, then investors look to bonds and cash instead of equities, as the returns obviously increase with higher rates. They can get guaranteed returns with less risk, and if there are fears of a financial crisis, they don't have to worry about their stocks potentially dropping 20 or 30% or something in a panic. On top of that, with higher rates, it means that financing cars becomes more expensive, which means the aggregate demand for autos will drop. However, Tesla want to increase their demand still, so they will likely drop their prices some more in order to bring back demand. But this will reduce earnings. So the result is that the P ratios in the market will drop due to the opportunity of investing in bonds, and then earnings will drop for Tesla due to cars becoming more expensive to finance. Tesla are, however, increasing the number of sales at the same time and reducing costs. So hopefully the end result in earnings may not be too bad. But the PE may suffer somewhat. The thing is, we know how much earnings Tesla should be producing. When rates are at a normal level and the economy is more stable, Tesla's vehicle prices should be higher and their costs lower. Earnings should probably be closer to around $20 billion a year, really. So we need to remember that, so that after we get past this inflation and whatever else is to come as a result of it, that eventually Tesla's earnings will return. And that's the earnings from current sales. We're likely thinking a few years ahead in time now, when sales have increased. We might have the Cybertruck at around 300,000 units a year. We might have a compact and a van, perhaps with an additional million or more units a year. And hopefully Berlin and Texas finally ramped and producing an additional million units a year too. Not to mention the semi-truck. Although not so many units, it will likely have an ASP about 6 times higher than the average passenger Tesla. So we should be at around 3.5 million units and back to seeing 25% gross margins. And energy should have hopefully ramped up a lot then as well, at least around 100 gigawatt hours a year. On Investor Day, they did mention building more megapack factories, so it appears to be on the cards. This is the prize we don't want to take our eyes off. With some very quick numbers though, if we have an ASP of 45,000 and 25% margin, then we have $40 billion gross profit from autos, and possibly another $15 billion from energy, which means earnings aren't going to be too far off about $45 billion when we include everything else. Well, not everything else, not even FSD. That will continue to improve over time too. So based on energy and cars alone, I think a PE ratio of 30 is fair. If Tesla are at 3.5 million vehicles a year, then we can see a market cap of perhaps almost $1.5 trillion, which is around 3 times today's value. I know many of you think it could be much higher, and I'm sure you're right. A PE ratio of 30 is likely on the lower side. And you know what? In my experience, Tesla's PE doesn't remain fixed anyway. It could fluctuate from 30 to 60 just over 1 year. And I think Tesla can hit this run rate sometime in 2025, which would be about 40% more growth year over year if we hit 1.8 million vehicles this year. Tesla's current PE is based off a $12.5 billion earnings from 2022. So if Tesla drops down to a PE ratio in the 30s again, it really starts to feel like a value stock, even just for this year, if it has a forward PE ratio of around 20. Of course, if we do hit a financial crisis, then all bets are off. But in the meantime, the market may price in some sort of recession to hit that could bring down the stock price. But even Coca-Cola has a PE ratio of 27, and think of how much more growth Tesla has compared to Coke. Most investors seem to have a price target of around $240 for Tesla at the end of this year, which is probably fair. If Tesla hit around $15 billion in earnings, then that would be about a PE ratio of 48, which in the current market environment seems to be about where Tesla is being valued. Of course, this may also get a boost if Tesla has started producing the Cybertruck. So we may see some sort of slump in the economy and Tesla's stock price may drop equivalent to a value stock. So when would we perhaps classify Tesla as a value stock? Probably when the forward PE ratio is around what Coke's PE ratio is, of around 27. And if Tesla are going to do $15 billion this year, then that would be when Tesla's stock price is at around $130, which would also be a market cap of around $400 billion, leaving potential to triple or even quadruple when we're up to around 3.5 million vehicles a year, which hopefully Tesla are close to by the end of 2025. $130 would require about a 25% drop in the stock price today, which is still quite significant. So to cause that, there'll have to be some sort of real fear in the market, or we'll have to find out just how well inflation is going and what will happen with rates. We also have Tesla delivery numbers coming up, which we're hearing mixed numbers for, with many investors concerned about potential drops in demand, but most bulls still saying that Tesla sell every car they make. This will be the first quarter since the drastic price drops we saw, so there's plenty of chance that deliveries will be good, and hopefully Tesla have found their market clearing price based on the higher rates and Tesla's increased production. Either way, the markets alone are going to remain volatile, and as always, Tesla is even more volatile. But as long as Tesla can continue increasing vehicle production and battery production, Cybertruck starts ramping next year, and hopefully add a new model around then too, then Tesla should continue to generate enough profit to look like even better value than some current value stocks. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.